Joining me now, someone who knows financial regulation from both sides, one could say. Ralph Schlosstein. He's a top deal maker. He was an economist for the Congressional Joint Economic Committee. He worked at Treasury, worked in the White House in the 1970s. He was a managing director at Lehman Brothers in the 1980s. Now he's the CEO of Evercore Partners, a boutique investment bank specializing in mergers and acquisitions. So you've worn a lot of different hats in your career.
Yes, I have.
Ralph, thank you.
And you left out 20 years as president of BlackRock.
That's a big one. We don't want to leave that one out. Sorry about that. So, Ralph, really what I want to ask you is, given regulatory reform, given these hearings that we've been watching on Lehman Brothers, and given the suit against Goldman Sachs, what's the mood on Wall Street right now?
Well, I think the mood on Wall Street is very much generally supportive of reform, because I think that the street recognizes that we need reform to make sure that we get rid of too big to fail, that we bring into the regulatory framework things like derivatives, and that there are protections for consumers so that we're not creating any more liar loans and ninja loans and products that never should have been created. Devil is obviously in the details.
Right, because at the same time, we've been hearing that many of the large firm CEOs have been lobbying hard to either not have reform passed at all or have it passed in a much diminished way.
Well, you have to understand that everything that increases transparency and everything that limits the range of products and complexity has some downward pressure on profitability. So, for example, trying to bring most of the derivatives that are traded onto exchanges and clearinghouses and out of the over-the-counter market ultimately will reduce profitability and increase transparency on pricing. That's something that the country should want, both because of cost associated with it, but more importantly, it makes sure that we don't have this massive, unregulated, interconnected world that can bring the system down as it did a year and a half ago.
Are there any implications in the regulatory reform, the various versions that we've seen, for your firm specifically?
Well, I think as a general matter, this is a good thing for firms that are not in the proprietary businesses. We are a pure advisory firm. Everything we do is advice-based. We never commit any capital in conflict with our clients or against the interest of our clients. Mm-hmm. So as a general matter, part of what this whole discussion is highlighting is that when you're in so many different businesses, it's hard to figure out how to serve all of your clients and how to also serve your shareholders, particularly when you're investing your own money.
So it's almost as though it's benefiting you by exclusion, that because you're not really coming under the purview of reform, that it puts you in an advantage.
That's correct. And our business is a simpler business that's conflict-free, and part of what is being discussed and challenged right now is that if you're committing your own capital, can you be serving your clients in a completely conflict-free way?
But, the people who are being regulated are your clients in many cases. Does that change at all, the deal-making that we're going to see? Does it change at all some of the advisory services that you're going to offer? Is there going to be less demand for that because they're focused on different things?
Well, I think the demand for advisory services tends to be driven by the direction of the economy, the direction of the markets, and senior executive confidence. All of those are strengthening somewhat. We're not expecting a big V-shaped recovery in M&A activity, but we have been on record as saying that we believe 2010 will be better than 2009, mm-hmm. and 2011 will be better than 2010. And we see a slow but steady pickup in activity.
Well, to that point, the first quarter for some was disappointing, not for your firm specifically necessarily. Your earnings were pretty strong, but M&A activity generally was weaker than some had expected. What does that say about what we're going to see for the balance of the year?
Well, partly, what shows up in people's reported earnings is really the activity of 2 or 3 quarters ago, because the revenues are recognized when the deals get closed rather than when they get announced. So we've seen a little bit of a pickup in announced activity, which would not necessarily show up in people's financials yet. So you would expect to see that more toward the third and fourth quarter of this year.
Now, at the same time, and you've been on Bloomberg talking about this before, your firm is also trying to diversify more into investment management because you're still very heavily reliant on M&A. And you've said you don't necessarily have a goal in terms of percentage, but what about timing? I mean, how aggressively, you've already made some acquisitions and some investments, how aggressively you're going to move into that area?
I think the key is we're in a people business. So we only expand when we find people who are A+ in quality and have a good cultural fit with our firm. That's true in advisory, that's true in money management, and it's true in our new institutional equities business. So I think it's fair to say that we will be on a steady pace of diversifying our revenues and diversifying our business. But to draw a map of that is somewhat dependent upon when great businesses and great people become available to us.